I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a guy who's an expert on finances. He's an expert on the bond market. 4 years ago, he wrote this book, The Coming Bond Market Collapse. Spoiler alert, his name's at the top, Michael Pento. And before I bring him on, though, here's a chart. He's been talking about the bond market and what kind of a big problem is. And you know things are bad. Let me let you read this. Bull market ends. This is from Bloomberg from just this week. And if you take a look at the 35-year trend line, down like that, and then boing, and it pops up. Right there, that's what we're talking about. Let me bring on Michael Pento, the bond expert, also financial expert, Michael Pento of Pento-Bond.com. Michael Pento, thank you for joining us today on USAWatchdog.com.
Hey, great to be back with you again, Greg.
Well, listen, this chart, and I'm holding it up here for you once again. I mean, you're seeing, even Bloomberg is calling that the bond market is coming apart. But I do want to give you some credit where credit is due. You only beat them by about 4 years in your book, and you lay out all the basics and all the fundamentals of why that you think that there is a coming bond market collapse, and it looks like it's collapsing. You said it would start about the end of 2016. That's pretty good, man. So tell me, it is starting. In your mind, do you agree with Bloomberg that it is starting? You predicted it 4 years ago.
Absolutely. So bond yields on the 10-year, they bottomed around 1.3% in July of this year, and they're doubled now, a doubling, up 100%. In the last year. And, it's no surprise to me that the bond market's in a bubble and it's bursting. We had at its peak $14 trillion worth of sovereign debt yielding below zero. Imagine that. The governments were getting paid to lend money out. So, this is an epic bubble. It's a worldwide bubble, and it's going to have massive, devastating consequences when it eventually does burst. And I said in the book, that the bubble would burst eventually because either a change in monetary policy would occur. In other words, they would reach their limits to how low they wanted to manipulate the bond market, the central banks, or inflation would start to rear its ugly head. And in the United States, we now have both. We have a Federal Reserve that, remember, when it was trying to elect a Democrat, I hate to be political, but I got to say how it is, Greg, in my opinion. When Janet Yellen was trying to elect Hillary Clinton president, there was no way she was going to be able to raise rates. None whatsoever. Now that Donald Trump is President-elect Trump, she now says that she can raise rates, get this, not just twice. She just had an FOMC meeting last week or a couple of weeks ago. She can raise rates 3 times in 2017. That's not a problem. And Mr. Fisher says, as the vice chair, maybe it could be even 4 times, 4 rate hikes in 2017. And we already have core inflation that's 2.1% year over year. So you have your inflation and you have the change in monetary policy. And I want to say this, there is an inexorably strong link between nominal GDP growth, which is real growth plus inflation, and the yield on the 10-year note. Well, we have inflation, as I just mentioned, at over 2%. And if you believe that growth has been 2%, real terms since 2010 under Barack Obama. If you believe that Donald Trump can at least get us to continue with a 2% real growth rate, that gives you 4% on nominal GDP. 4% nominal GDP. Where's the 10-year right now? Well, it was 1.3. Now it's almost 2.6. We're going to 4%, Greg, on the 10-year, in my opinion. And that, by definition, is an absolute bursting of the bond bubble. And I'll tell you this, the problem is this, all assets are priced off of that risk-free rate of return, that quote-unquote risk-free rate of return on sovereign debt. And all asset prices are priced off, what, 1.3% on the 10-year Treasury, or negative 0.40 basis points on the Japanese 10-year, or negative yielding German bunds. All assets. And yes, that includes real estate and stocks. So the bond bubble is epic. It was epic in proportion. It affected all asset classes, and it is now bursting.
Well, what does it look like when it breaks up? Some people, some of the big houses, Goldman, J.P. Morgan, even Jim Sinclair, they're talking between 2.75 and 3%, and all hell is going to break loose somewhere in that neighborhood. And so, what do you say? When is it? When is it going to break loose? When is it? When are people going to start selling in mass? And what does it look like when this thing bursts? What does it really look
Well,
like?
first of all, okay. So first of all, I believe that I said I think 3% would be the tipping point. Psychologically, 3% is it's a round number. 3%. And also, mathematically speaking, it brings risk premiums in the market down to single digits, like 1% in risk premiums. So when your risk premiums are 1% instead of 3 or 4 where they were, it just doesn't pay to own stocks. But most importantly, I will tell you this: the real estate market is starting to go offline. If you look at new home purchase applications, if you look at new home starts, they're down. They were down 19% in November, month over month. 19%. There is no more refinancing market. It has gone offline. Initial purchase applications, as I mentioned, have flatlined. So that once the housing market goes offline, and it's starting now, but at 3%, I think it goes completely offline. And as the housing market goes, so goes the economy. And I'm going to talk a little bit later in the show also about, it's not just the United States. What happens to China? What happens to emerging markets? I'll give you this little data point. While the Dow Jones and the S&P 500 have surged after November 9th, under Trump's election, emerging markets are down 8%. The Chinese renminbi is in free fall. And this is causing big problems. It's not just the bond market is blowing up in the United States. Bond yields have soared in Japan. Japan now has a positive 10-year yield. Europe has a positive yield now. And the emerging market economies and their currencies are crashing. And that is where I think the epicenter of the bubble breaks. It's going to cause the housing markets to go offline. It's going to cause a huge rotation out of stocks back into bonds for a while. I believe that this is just by the way, I want to be very clear about this. I believe this is just one fissure, one major, I'll call it earthquake, a tremor, before the major violent earthquake occurs. This is just a tremor. I believe yields go to 3%, maybe even 4%, and then we have a stock market crash, and then we get Janet Yellen and all central bankers back in the QE game simultaneously, concurrently, and that will bring bond yields down for a while, and then you'll have the real crash where bond yields go 10, 15% on the 10-year, just as they did under Arthur Burns in the 1970s before Paul Volcker came in. So we're going to have a bond market collapse now. It's just it's going to feel like a major earthquake, but unfortunately, in my view, it's just a tremor as to what's going to occur when we go to intractable monetary creation and helicopter money. That's on the other side of this tremor.
What's the timing on that? Are you looking at this summer, this fall? Next in 17 sometime, correct?
Boy, oh boy! I mean, maybe you should have wrote a book about it. So
I couldn't. I'm asking you. You're the expert. Well, that's what people are thinking is, when does this happen? When does this happen?
I think you're seeing emerging markets unraveling right now. You're seeing emerging market currencies unravel right now. I think that causes a huge crack up. Now, I got to tell you this. Let me just tell you this. In December of 2015, the Fed raised rates. You remember that? The first time in a decade.
Yeah.
Janet Yellen, and from the middle of December to the end of December, it was nirvana. Oh, they raised rates. There was no problem. And then came January. And the first trading day of January, boom. And we had the worst January in the history of all Januaries in the stock market. I think the very same thing is going to happen. But I think it's going to be worse. Because as I said, not only are we going to fall, I think it's going to be a huge tremor in China and in the emerging markets. And when that occurs, I think, and that's early 2017, I think Janet Yellen, forget about 3 rate hikes. I don't think she gets more than 1 out of the way before this whole thing unwinds and unfolds. And that's when you're going to get a reversal of those rate hikes. You're going to go back into QE in 2017. So get ready. I know gold is suffering huge right now. And full disclosure, I sold most of my gold after the election of Donald Trump, because I knew that we had rising real interest rates, rising nominal rates, and rising real rates, and a stronger dollar. It's temporary. It's not going to last very long. But when it reverses, oh boy, it's going to reverse really, really hard and really strong.
Are you going to be able to buy your gold back when you know? I mean, I know you like physical gold as well as the GLD and other mining stocks and stuff like that. Are you going to be able to buy it back? You'll be able to catch that?
I think I will be because listen, I'm an active manager. If you're a long-term holder of gold, you should hold gold. In fact, if you're a long-term holder of gold, you should be using this sell-off to buy more gold. But if you're an active, you've got a dynamic portfolio strategy like myself, which is called the inflation deflation dynamic portfolio, and your model says, hey, you've got real interest rates rising and you have a dollar rising, well, you can lighten up on your position and buy more when it gets to appropriate levels. And I think when the bond, this is going to reverse in early 2017. My opinion, you're going to hit 3 or 4% on the 10-year. The whole scam is going to blow up because we have a record amount of debt worldwide. What did they do after 2008? They took interest rates that used to be 1% in 2003 and 2004, right? They went to 5.25%. The world blew up, as it always does, because central banks always blow up bubbles and then they blow up the world after that when they try to fix them. So what happened was we took rates down to 0%, Greg, for 8 years. Are you going to tell me that's going to work out well? That's going to be the big difference? You know, we had a 1929 a bust, 2000, 2008. You think that 8 years of 0% rates and 0% borrowing, virtually zero across the board, across the world, that's going to end well? That's going to be the exception? No way. So, but here's the problem. The problem is central bankers are patting themselves on the back. What a great success we've been. You know, what a great job we did. We blew up all these asset bubbles, and now things look kind of, sort of okay. And we don't really like Donald Trump anyway, because we're Keynesians. So let's start raising rates, and maybe even doing it violently. Hey, this thing's going to unravel in 2017. That's going to be the year. And then you're going to see, I believe, helicopter money on the other side. So you better be ready, prepared to own gold again if you sold it.
When you're up, people have to understand. They'll say, "Oh, Michael Pento's been telling us to buy gold, but he bought gold." Again, you're an active manager. Your portfolio's up. Didn't you tell me in the pre-interview 12%?
The model portfolio is up 12% on the year. Yeah. Okay, we experienced a big rise in gold. I thought gold would go up early in 2016. It did. But when I saw what's going on with Janet Yellen, the change of the Fed, and I saw rates were going to be rising in nominal and real terms, when I saw the strength in the dollar vis-a-vis other currencies, I had to lighten up my position a little bit. Yeah, we don't talk every day. That's the advantage of being with my firm. But listen, you're not a day trader. Your audience, you're not a day trading audience. So for your audience, they can say, "Hey, Greg, you guys come on your program, tell me to buy gold. I bought gold and I'm down a little bit." Well, you should be using that as a buying opportunity, because I'm telling you, as I just ended up saying, this stronger dollar, this rise in Treasury yields and plummet in prices in Treasuries is not going to last very long. They're going to have to reverse course. But when they do, they're going to temporarily bring that yield back down. But they're going to create such unprecedented inflation like you've never seen before, even worse than what we saw in the 70s. And boy, you're going to want to have gold at that junction.
I wanted to come back to how this is all interconnected. And in your piece, I said I was going to read this, but it's such a great quote. I'm going to read this to you. And you say in your piece, you talk about China, and this is kind of your summation. You say, "Therein lies China's dilemma. Allow the yuan to intractably fall, which will increase capital flight, destroy its asset bubble economy, or raise interest rates to stabilize the currency and risk collapsing asset bubbles that will crumble under the weight of rising debt carrying cost." In other words, China is damned if it does and damned if it doesn't. I mean, they're in big trouble. That's why they're selling their bonds. They need the money.
Hey, that's a perfect quote. I'm glad you read it. That says it all. But what happens when China has to repatriate their currency? What are they doing? They're selling their hoard of treasuries. What does that do? It puts more upward pressure on treasuries. Listen, like you said, China is doomed. China is done. Their bubble illusion economy is over and done, Greg. Listen, they have quadrupled their debt 4 times. Since 2007. And they did it by building empty cities and blowing up a stock bubble and then a commodity bubble. And now they're trying to blow up the real estate bubble all over again. So what's happening is, and it's no mystery, they have an offshore yuan. It's not just that the Chinese control their yuan. By the way, they control their yuan. It's down almost 10% in 2016. So if you're a holder of that yuan and you have an apartment building that you purchased on margin, what do you want to do if you're a Chinese citizen? You want to get the hell out of Dodge.
Sell.
You want to sell your building, you want to sell your yuan and get out of that currency. That's devastating for an economy which is riddled with asset bubbles like China is. So their yuan is falling. So what happens on top of that is we have Janet Yellen going to raise rates, maybe 3, maybe 4. We don't like Trump. Maybe we'll get him the hell out of office and, maybe we'll get him impeached. Get him out of there as quickly as we can. Maybe raise rates 4 times in 2017. That's going to put more pressure on the yuan. So what does the PBOC do, the People's Bank of China? Maybe we could stem that tide by raising interest rates. And what do you do when you raise interest rates on asset bubbles? Just ask Mr. Bernanke in 2007 how that worked out.
They blow up.
China's either way, Greg.
So China is going to turn into a hyperinflation, whatever, and then people be crazy. Or China will implode in rising interest rates, and everything, and the whole real estate bubble will implode. Either way, China gets creamed. Is that right? Could China cause the whole world to go into a tailspin?
Well, you have to ask yourself. The answer is yes. You have to ask yourself, why are emerging market stocks down 8% since the election of Donald Trump? Why? The answer, and it hasn't been because U.S. stocks have been going down. U.S. stocks, as I said, they're surging, and they can't see any problems at all until January 2nd or 3rd, the first trading day of the new year. That's going to be the big. I think that's when we start to see this thing all unravel, just like we did in 2015. Same thing's going to occur. No, things aren't okay. We've got huge problems coming up, and I think the epicenter of that tremor, which is going to feel like a 10.0 on the Richter scale, is emerging markets in China. That's where you're going to see it first. And you're already seeing it in the currency. And yes, you're already seeing it in emerging markets. Pull up a chart of the EEM, pull up a chart of the Shanghai exchange, and you'll see that I'm correct.
I saw, and maybe this is a contrary indicator, I don't know, you tell me. I saw on Zero Hedge, one of the titles was, "There are no more bears." And well, you're one, but tell me, is that a contrary indicator? Should everybody think it's Nirvana? Trump's in. He's going to save the world. I mean, I love Trump. Don't get me wrong. He's way better than the person that thinks there's limits to the First Amendment. That's Hillary Clinton. She said that with Chris Wallace. But anyway, do you think that there are no more bears and that everybody should be fat and happy and just all into the stock market?
Well, like I said, I don't consider myself a bear. I consider myself someone who wants to make their clients money. So like I said, the model portfolio has done very, very well this year. Am I a bear? No. Am I one of the few people who doubt that this rally can continue much longer? I think I am. A very, very rare breed indeed. If you look at the VIX, which is the volatility index, it's at 11. I mean, they're just throwing money. Hey, let's have the dollar go to a 14-year high. That's not going to affect multinational companies' earnings on the S&P 500. Hey, let's have the bond yield go to 3% is fine. Well, that's not really okay. Well, no one's going to be able to buy a house. The first-time home buyers been completely shut out because home prices are rising, and now the cost of owning that home is surging, and their real incomes haven't moved at all. I, like you, believe Donald Trump's going to be very good for the economy. Maybe in 2018, once he passes, if he really reduces taxes. But what is he really going to get done? Does anybody really know? How much regulations is he really going to abrogate? Like I said, I think he's going to be tons better than Barack Obama, which really my 5-year-old daughter could have done a better job than Barack Obama. And he's going to be much better than Hillary Clinton. But things, when you try to think of GDP growth, it's a function of two things, and it always has been and always will be. It's productivity plus labor force growth. So productivity enhancement, Trump is not going to be able to increase the labor force immediately, and he's not going to be able to increase productivity right away. So what you have had the price of the 10-year note plummet. You've had the yield double in just the last few months, yet GDP is stuck at around 2%. GDP hasn't moved yet, and Trump hasn't been sworn in. So in early 2017, I see the bond yield soaring, continue to soar, and I see big trouble ahead for the stock market because nothing Trump will be able to do will be able to affect GDP growth for months.
You think that this crash, at least the beginning of it, the first round of it, is going to break up before he sticks his hand on that Bible and gets sworn in on the 20th of January? Is that right?
I think that the first or second trading day of the year is going to be very, very bad because everybody who's been buying willy-nilly, buying anything and everything that they can get their hands on, because they don't want to pay capital gains taxes in 2016, because one of the things we're hoping for is that Mr. Trump will lower the capital gains rate. So if I sell stocks today, I've got to pay that old, not only do I have to sell my stock, but I have to pay the old rate. If I sell them on January 2nd, guess what happens? I can get cash in my gains and pay the hope for much lower capital gains rate. So boy, oh boy, it's going to, I believe, and listen, am I God? Not even close. But I can tell you this, if I look at everything that's going on with the dollar, everything that's going on with the bursting of the bond bubble, and that everybody has now a 10% gain in the S&P 500, and they don't want to sell it to get that higher capital gains rate in 2016. They're going to wait to day one, 2017. I would be very cautious jumping on top of this thing, Christmas Eve, or Friday before Christmas. The last trade, whatever the last trading day of the year is, up until January 30th. So be very cautious buying the stock market right here, unless you're going to be out in like 10 minutes.
That's a very good piece of analysis for people. That everybody's hoping that they'll pay the lower. There'll be a lower rate, so they'll sell on the first trading day and second trading day of the year. Wow, that could be. We could be looking at on the 2nd of January overnight limit down on the S&P.
Oh yeah. I mean that's your prediction. I wouldn't say it's impossible, but then don't forget, selling begets selling. So people don't even know why they sell. Like, oh my gosh, let me cash out right now. So you could get a panic like that. But I still believe that sometime in the first quarter of 2017, bond yields go to 3% on the 10-year, and you have this epic unwind. That tremor ends, and you start getting people buying bonds and selling stocks. You're going to have a reversal of that trend. And the economy, by the way, as I said, the economy has not had anything positive happen to it. Nothing yet. Only this shot of confidence from Donald Trump. And confidence is very ephemeral and ethereal. I mean, it's confidence, yeah, but can you really be confident when you have a student loan outstanding or an adjustable rate mortgage? How about those people? There's a lot of people out there who invest in something called the modern portfolio theory. Well, what does that mean? I got about half my assets in stocks and about half in bonds. Well, don't open up your bond statement unless you're sitting down, because you're down about 10%. You've given everything back that you made in stocks, and you've given them up in the bond market. And I want to say this before I forget. I want to talk about just about how high deficits could rise in 2017. We have a baseline projection. We already have a deficit that's projected to be over $600 billion in fiscal 2017. Well, the first 2 months of fiscal 2017 are in the books, and the deficit for just those 2 months is well over $200 billion, up 10%. And that's before we have to have any tax cuts figured in there, any infrastructure figured into that deficit. That's before we pay the extra interest on the debt. For every 25 basis points, it's $50 billion. So what I'm saying is, listen, before we even start talking about a recession that could occur, we're probably nudging up against $900 billion to $1 trillion deficit 2017 if Trump can get his way early in his administration, the first 100 days. And then if you have a recession that occurs, which, by the way, we're way overdue for a recession, then, like in the last recession, deficits jumped by $1.2 trillion. So you could have deficits that are $2 trillion in 2017. And I have to ask, who's going to buy them? If Janet Yellen is a seller of treasuries and the ECB is tapering, European Central Bank is tapering, and China is a huge seller of our treasuries, hey, listen, I don't know if I mentioned this yet already, but if I didn't, I sure as heck should have. China has to sell their treasuries to buy renminbi, buy their yuan, to prevent it from falling off a cliff. They're a seller of treasuries. So Janet's a seller, and the ECB's winding down, and China's a seller. By the way, if you're
and this means, and hold on, and this means that the Fed is gonna be in trouble if they're selling if everybody is selling and nobody is buying this debt. You're saying that interest rates could they'll have to let the interest rates fly up high, 8, 9, 10, whatever it is, 7%, or they're going to have to buy all the debt.
Greg, they'll never let it happen, because I think, like I said, the economy falls apart before any of that can happen. So at 3-4% 10-year, the economy falls apart, and Janet Yellen's going to say, "Oh boy, listen, the Fed has made the same mistake that it has done every time since 1913 that it's tried to raise interest rates after they created a bubble. They go too far, they create an economic collapse, and then they have to reverse course. I mean, that kind of is the modus operandi.
And that's
what happened. And it's going to happen again. And it's going to happen rather quickly. Because, like you said, if I have a $2 trillion deficit, and Janet Yellen is going to say, that's how they raise rates. The only way I know of to raise rates is to drain money supply from the banking system, that interbank lending rate. They have to absorb that cash. They do that by selling treasury. So they're a seller. They'll be a seller. Mario Draghi has gone from 80 billion to 60 billion euros a month. He's starting to taper. Okay. You have, like I was going to say, if you're an OPEC producing country like Saudi Arabia, guess what you've had to do? You're a seller too, because oil went from $100 a barrel to $30 a barrel. Okay. It's up around 50 now, but I don't think that lasts very long, not with a strong dollar. So OPEC's a seller. China's a seller. Guess who else is a seller, Greg? Japan has been a huge seller of our treasuries. I mean, who the hell's left to buy treasuries? Not when they're yielding, what are they yielding? 2.6%? And inflation's at 2%, and real growth is at 2%? There isn't going to be a buyer for these damn things until it hits 3 or 4%. So watch out. I mean, you're going to get, these Keynesians believe they solved all of our problems by taking on an incredible amount of debt, total debt in the world now. I think it's at 230% of GDP, $230 trillion, almost 300, $230 trillion, almost 300% of GDP, $60 trillion added since 2008. The United States doubled its debt outstanding under Barack Obama. Okay? You can't have a bond market collapse, an epic bond market bubble collapse, and have it done with impunity, completely without harm. When is the precedent for that to occur? Like I said, in 1987, we had a crash in the stock market. But guess what the debt to GDP was in 1987? 66%. Total market cap, not the debt, total market cap to GDP was 66%. Do you know what it is today? 127% of our economy. Almost an all-time record high. Way higher than it was in 2007 and just below where it was in 2000. The baseline for that metric, which is total market cap to the economy, is about 55, 60%. We're at 120%, 7% of the economy, Greg. There are bubbles abounding everywhere. And if the Keynesians think that they can raise interest rates with impunity, I say, go ahead, go for it. I'll watch it all crumble. I have a lot of cash, and I'll pick up the pieces on the other end.
Where are you going to go back into gold? So eventually the trade is going to be gold's going to ricochet back up. And for people holding physical, you're saying, just hold your physical. This is going to turn around. Where are you going to go back in? Where do you think the bottom is on gold? Or are you looking at interest rates as opposed to gold?
I am looking at economic data. I am going to watch this continue, and I'm seeing it already happen, Greg. Before anything good from Donald Trump can occur, anything good, you are watching housing go offline. You're going to get some pretty crappy data points for December and January. So they come out in late December, late January, early February. You're going to start to see like, whoa, wow, look at that! Look at those retail sales. Oh, look at that personal income and expenditure. Look at those new home starts. You're going to start seeing data that's directly affected by that spike, that doubling in yields, which is continuing to this day. So that's when I think we're going to start to say you're going to start to see the slowdown in appreciation of bond yields, slow down in the depreciation of bond prices somewhere in early first quarter of 2017. And I start seeing that. I know Janet Yellen isn't far behind. By the way, there is precedent for this. If you look at what happened in 2000, in the end of 2015, what happened, Greg? They raised rates, and they were supposed to go 4 times, right? 4 times. In 2016, guess how many times they went? They went 1 time. Okay.
And then gold went up in the early part of 2016.
What was the good? Yeah, I'm getting to that. So what was the main reason why we went from a rate hike in December of 2015, 1 rate hike, and we recanted on the 4 rate hikes? It was the economic data. So January started lousy year, worst year for the stock market. The stock market and economic data will head south. And guess what happened in 2016, early 2016? And guess what's going to happen in early 2017? It's my belief that you're going to get a parade of FOMC open mouths getting on television saying, hey, well, maybe 3, too much. Maybe it's just going to be 2. Oh, maybe 2 is, no. Maybe we just do none in 2017. And as the economy goes down and down and down, they're going to have to revert. Oh, you know what? Rate hikes off the table. Done. We're out of rate hikes, and we might even go back into quantitative easing. So look for that all to play out early in 2017. It's my base case scenario.
That's a good roadmap, my friend. Michael Pento, I hope we've been talking about this in the pre-interview, you guys haven't heard, but he predicted this in 2012 when it would start. It happened. All the basis for this bond market, I'm holding up your book, Michael, it's the coming bond market collapse. I hope you do update this bad boy. You are the man. I really appreciate you having you coming on and talking about this rate increase and the 10-year Treasury, which a lot of people are having a big yawn. But you're saying warning, danger, big problems coming down the road, and that's the tip of the iceberg, correct?
Well, if I'm wrong, it would be the first real true bubble that ever popped with impunity. It's never happened before. Why in God's name would it happen again? I hope it does pop harmlessly. But it's my job to prepare you, going through history, seeing what's happened in the past, and preparing you to profit from it.
Could banks close down in this? Could banks close down? Could markets close down? Could brokerages go out of business? This is the Mac Daddy, the granddaddy of all credit bubbles around the world, correct? So could this shut banks down, shut brokerages down, shut the financial system down?
Well, it could, unless Janet Yellen immediately goes back into quantitative easing, and that might buy them a little more time. But again, I'm a student of history. When has hyperinflation ever saved an economy, Greg? That never has happened before. There's hundreds of trillions of dollars worth of these interest rate swaps out there. And these people who have exchanged a fixed stream of assets for a variable rate. Well, these people, just like AIG, they don't have the capital. If rates go up too high, they're going to say, hey, listen, I can't pay your variable rate loan. So then there's 2 people, counterparty risk. You go out of business and your counterparty goes out of business. These are things that people aren't thinking about. By the way, do you think you could take China, the number 2 economy on the planet, offline and all of the emerging markets and not affect the U.S. stock market? I mean, you want to go ahead and buy this hype and mania when we really think Donald Trump's going to be very good for the economy, maybe in 2018. But do you really think that Donald Trump, whatever he's going to do, is going to offset immediately what's happening right now with the busting of this bond bubble? There isn't a chance of that happening. No way. So that's what I think we should do. You should be prepared to profit and buy back stocks at much cheaper valuations, just like we did in early I think it's going to be 2016 redux.
It's Michael Pento, Pento Portfolio Strategies. His website, Pento-Port.com. His book is on the website. I mean, listen, even though it's 4 years old, it lays out the basis of what he's talking about. It's a nice, big, thick book. You'll love it, folks. Michael Pento, thanks for joining us today on USAWatchdog.com.
Great to be with you, Greg.
Oh, and Merry Christmas.
Oh, God bless you and Merry Christmas, too.
Have a good one, my friend. Merry Christmas.
Thank you.